Don't lose money. Invest with certainty. Welcome. I'm wishing you an incredible day. We start at 5 o'clock. We drop episodes every day. This is the 5 a.m. Club with DJ Smooth all the way from Johannesburg in South Africa. So I've just finished a book called The #1 Investing Rule. Let me actually get you the exact name of the book. I'm going to get you guys the exact name of the book. And I want to summarize it for you. In case you haven't had a chance to read this book, don't worry, I'm over here for you. And I'll be doing a lot of this more so that other books that you haven't read, you can sort of get a summary from me. And then you can decide yourself if you want to go still read that book, or you'll just take my word for it and be inspired by what I share. Rule #1, the simple strategy for successful investing in only 15 minutes a week. That's what I read, because nowadays I listen to audiobooks. I read a book a day. I read so many books and they make me a better person every day. I hope you read. And I'm not saying physically reading old school physical books. I think you can listen to audiobooks. They'll change your life. Just listening to all this positive audio in your ear is always a good thing. Now, I've made my own summary. I've taken my own notes on what the book is about. Don't paraphrase me. Whatever you understand or how you comprehend the message that I'm going to share with you, it should inspire you to go read the book yourself or go listen to it yourself. You can actually finish the whole book in less than an hour. You can even finish it in about 30 minutes. The summary of the book, here we go. Don't lose money. What do they mean by saying don't lose money? Invest with certainty. And some of my notes that I took here, I took some bullet points as well. Business must meet your values. They say, if you're going to become a good investor, you must be willing to buy a dollar at half the price. You must be willing to buy a rand at 50 cents and then to sell it at a rand at a later stage, or to sell the 50 cents at a dollar at a later stage and then repeat the cycle. That's how you become rich. But for those who also trade stocks, or for those who buy and sell businesses, for those who trade in the Johannesburg Stock Exchange, for those who've got apps like about Easy Equities, they will tell you, because they've got knowledge of this, it's a good thing to do and it's a smart and safe way of investing. If you buy at 50 cents and you sell at a dollar, and repeat the process. But you gotta follow the 4 M's of the business. #1, they say the management of the business. It's gotta be a business that you're paying your attention to. You're studying it, who's managing the business, what type of team they have. You're doing research about them, who's worked in that business, for how long, what is their history, how well have they performed in other companies that they've worked at before. And then you also, the structure of the business. Who's the CEO? Who's the CFO? Who's the COO? What does the team look like? How long and how well have they been performing over these past couple of years? And then another M as well that they will talk about is I'll come to the 4 M's a bit later because my mind is running. So I said it must have good management, but you must buy it at an attractive price. And most recommended by this book, the #1 Investing Rule, it says 50 cents and sell at a dollar. Know the worth of the business. Understand the business. Or does the business meet your values? Are you aligned with what the business says it does? If you don't agree with what the business does, if maybe your religion does not allow you to support alcohol or vouch for alcohol, why would you invest in an alcoholic company? Find a good business, know what it's worth, pay half for it, repeat. If a business has 4 M's, it is worth buying. And I'll come back to the 4 M's in a moment. They say the 10-10 rule, I won't own for 10 minutes if I won't own it for 10 years. What does that mean? Basically, that means, these are some of the notes, by the way, that I took as I was reading the #1 rule in investing. Which means, if I can't own it for 10 minutes, I must not be expecting things will get better over time. I must just make one rule and decide that if I can't own it for 10 minutes, then I can't own it for 10 years. I will not own it for 10 minutes if I won't own it for 10 years. You must look at a business whether its future is predictable. Study historical data of the business and its previous performance. It talks about a wide protective mode. It talks about examples like companies like about eBay, Gillette, Wrigley, Apple, Coke, Pepsi, McDonald's, Nike, etc. It's companies that are able to raise their prices at will. It's prices that have survived multiple storms, multiple recessions. It's companies that can have built a brand with the product trust, the business with trade secrets, switching part of your life, can price products low. What is this? Can price products, the business can price its products low and no one can compete. There are such businesses, and other people call them monopolies, where they can still price their product low and no one else can compete at their will because they can control the market. Those are some of the good businesses that you can look at and study well and invest in as well. They're saying that right now the statistics look at Coca-Cola sells about 10,000 bottles every second. It's a statistic, go research it. Coca-Cola now sells an average of about 10,000 units per second. How much is that? So if you're investing in a company like Coca-Cola, you are checking, okay, it's been around for over 100 years. You are checking on some of the best years that it has performed well. You're checking on some of its worst years, and you're checking some of the numbers that it's done. You look at its CEO, you look at its team, who's running the team. You look at its values, the company's values, are they aligned to yours? You look at such things. You look at the sales growth rate. How much is it growing at every year? The earnings per share. Equity of book value per share, they call it BVS, cash flow growth rate, equal or 10% per year, but they always advise and say at least 15%, not 10%. If it's growing at a 15% rate every year, then that's a good business. But is it going to continue growing at that 15% rate every other year? So those are some of the things that you should predict before you invest in a long-term company like that. But they also say diversify your portfolio. As long as you've diversified your portfolio and every time when you buy, you're buying at 50 cents to sell at $1. But a lot of the times what they advise is be that type of an investor who invests and looks at things long term, having diversified your portfolio and making sure that whatever you've invested in at least grows at a 15% rate per annum. Then you'll find yourself very wealthy over time. For me, I look at investing as something that should be replacing saving. I know we come from black communities and it's been drummed into our minds when we were growing up that we should save, save, save. To save is a good thing. But I'd rather advise young people, and I'm not a financial advisor, I'm not a professional, consult professionals, but a lot of them will tell you the same thing, that instead of investing, I'd rather put my money to work. Instead of saving, I'd rather invest and put my money to work. That's what investing means. It means your money is working on your behalf. Saving is you're exchanging your time for money that you earn because you are there, you're doing the physical work, and when you earn this money, you're putting it away in a bank, for instance. But we all know what are the percentages that look like at the bank. You're looking at 5%, 6% growth rate per annum, 7%, 8% if you're lucky. But with all the bank charges, it usually goes down to 5, 4%. If you're lucky, at least 5%. That's why they encourage investing. Because when you're investing, you can diversify your portfolio and make sure you're buying at 50 cents, selling at $1. Or if you're investing long term, look at companies that you know they're growing at least 15% growth rate per annum. So replace saving with investing. Start learning investment books. Start familiarizing yourself with financial or money books. Start bettering your relationship with money. Start doing away with all of these conditionings or this indoctrination that you've had where they say to you, money is the root of all evil. Money is bad. Money is evil. All of those things are lies to keep you poor. All of those things are lies to make you wait so you become a very good poor servant and expect to be in heaven when you die. No, not while other people are living their heaven on earth. You should be living your heaven on earth right now as well while you're alive. And as you're pursuing your dream, as you're pursuing your purpose, as you're pursuing your vision right now as we speak, start turning your habits from saving to investing. Start reading investment books. Start understanding how you can make money work for you, how you can better your money relationship, how you can lessen or alleviate your spending habits, how you can start buying more assets as opposed to liabilities, how you can learn the money language, and how you can start connecting and vibrating on that energy of money, because they say everything is energy. And other people who have a lot of it, they even actually say money is easy. It's just us with our mouth. We always say, hey, kunzima, hey, kuyabheda, money is difficult. Cancel all of that and believe, nyokepaya. Nyokepaya, and then in twanetse, and then nayangata, and kitloyeta epaya, ibile knaleona. Because mudimu angata, and mudimu ratilor, am fechelete paya, ibile, lehelor kia insa, kireka something. I'm not spending, I'm circulating it, because it's all gonna come back here. It must come back with its friends. It must come back with its aunts. It must be polygamous. It must come with a girlfriend. It must come back with 3, 4, 5, 7, 9, 10 wives. It must multiply. It must come back here with it. And when it comes back here again, I must put it more work. I must put it back to work again. It must go do more work. Meaning I must invest even more. So black people, let us start adopting a culture of investing as opposed to saving. Yes. Let us get used to investing more than just saving. And as I continue the summary of the number 1 investing rule, they talk here about having to study the CEO of the leader of the business. Are their goals aligned with that of the business that they're running? Are they practicing what they preach when they talk about representing this company? It has to be owner-driven CEO that sets their goals aligned to their business, walking the walk. It must be a CEO that pretends that company which they're CEO for is the only company they'll ever own, even if it's not true, but they must convince you that it is the only company they'll ever own, so that you're convinced that the leader who's running this business that you're investing in is a horse that you can bet on. And for you to know if he is a driven CEO or he is a driven owner-based CEO, check their history. Read their annual letters to investors, owners. Read the company website. If their company had a bad year, check what they wrote in the letters and how they plan to remedy. Or else, if he's not having a clear plan on how to remedy or ride that storm or ride that horse as it moves on the next year or do better, or promising to do better next year, and you're not sure of what they're writing or what they're saying or what their history is saying, then just don't ride that horse with them. Demand a margin of safety. They call it MOS, is what I was saying earlier. Buying $1 for 50 cents. Half of whatever the sticker price is, that's your MOS. Will not only making money, it will keep you from losing it. That MOS. Because if you've bought a business for 50 cents and planning to sell it at $1, at least you've got a safe margin or safe landing spot there, even if anything happens into the marketplace. Intrinsic value, retail value, aka sticker price is what they would call it on the book. Know when to sell. The right time to sell is never, as Warren Buffett says. You can never know when to sell because you can predict and predict and predict. History tells you this. Reading the markets and knowing and understanding the investing game says this, but then you find that the actual game can be something else. That's why Warren Buffett will say words like that, like, hey, the right time to sell is never. Because some people believe if you have invested in a good business and you've followed these strategies, you don't have to sell. Why sell a good asset? Why sell an asset that is doing well? Those are some of the beliefs that people like about Warren Buffett have. I mean, I don't know how long he's owned or had shares at Coca-Cola for. And some of the other companies that he is a investor in. Berkshire Hathaway has been around for many, many decades. And it's been consistent over the decades. But then again, it comes with Abu Warren Buffett being the dogs of the game and understanding this game way better. Because he started out as a teenager. As a kid, not even a teenager. He was a preteen when it started. As I repeat again, the business must at least have 15% or more per year growth rate. has great meaning to you. You can't invest in a business that doesn't have the meaning, a good meaning to you. So I spoke about management earlier. That's the one M. That's another second M, meaning. The business must have great meaning to you. Is it aligned to your values? Does it mean much to you? Is it saving the world? Is it aligned with what you believe in as a person as well? You must be proud to own this business. That's why you must understand it. Get in the game and learn with baby steps. Create a watch list. If you miss buying the business based on what you know, then you can always invest on the next business, but don't invest in a rush, especially if the market is saying one thing about a business or all the articles are saying something positive about a business. You must be very cautious. Don't just jump in because everybody's jumping in. Be so good in this investment game that you're one of the people that come in early, so that when the buzz is there with a company or about a company and everybody's now jumping into it, you're one of the people to come in early because you were able to do your own due diligence and you've done your homework earlier first, and you're one of the people to come in early. Do not allow fear to hold you back. We're not saying be reckless, but the book says don't allow fear to hold you back. Believe that what I'm investing in is going to yield returns based on the research that I've done, based on these 4 M's that I'm following, based on buying for 50 cents and promising to sell at $1 or expecting to sell at $1 at a later stage, based on its values that it represents, what it means to me, the management structure that it has, and how well it's been performing over the years based on the historical data as well. This is a business that I think I can go a long haul with. Know what you're doing. Invest with certainty. Diversify and hold on for longer. Those are some of the people that become greater investors, who diversify, hold on for longer, as I did say earlier, as long as you know that each and every basket where your investments are in, you are at least making 15% minimum per annum. And then in closing here, I would like to say, in the investment game is the most important game that I'd like for our black people to go and learn, to familiarize themselves with. I'm also new in the investment game. It's only been, what, like maybe 10 years now? I used to just be the person that is about just chowing, that is about the bag, about the quick bag. But while all these sports cars and fancy clothes and all these different things that one has bought over the years, I can't point them now here because I wasn't working with an investor mindset. I was working with the mindset of trying to get validation, of trying to look good in public, of trying to be that rich guy, of trying to be the man, right? But as soon as I changed that, I think I was even trending. Maybe it's like now, what, maybe 8 or 9 years ago, where I think I trended for these headlines. People, I think I said something along the lines of, I'm not poor, but I'm currently broke. I think I said something like that. I don't know who remembers that. And that's when I was starting to change my mindset. That's when I was starting to read financial books. That's when I was starting to actually start practicing not having to rush for immediate quick gains. And I even write about it in my books, and I say, rather than get your quick fix or your quick short-term paper, why not invest in the long paper or the long game? And I'm glad that I made those decisions, because I would have been one of the artists that just sits here right now and I talk about all the great times that I used to have when I used to have this hit album, when we used to be on stages, when I traveled that country. And it's great because you've amassed all of those memories with your loved ones. You've lived life and it's a good thing. But you don't have anything that you can point and say, I built that, I built that, I built that over there. So the minute I started switching my mindset from being a short-term based type of a person who was looking for instant gratification or the instant bag, and I started looking at things long-term, although that came with a lot of doubt, that came with a lot of criticism, and that came with a lot of toll to my own family and to my own life. I'm glad that I made those decisions, because now it's damn near a decade later. I'm proud of what we've been able to build here. I'm proud of what I've been able to build with writing informative books that are going to be relevant forever. Youth of 2070, 2090, 3000, they'll be reading my books and be relevant. They might not be 100% relevant at the time, but they'll be most likely highly relevant, because yes, times would have moved on, times would have changed, but I do know that a lot of the information that I show in my books is based on my own case study, my own life. So it'll forever be relevant because it's my story and it's something that I've lived. Although some of the opportunities of business that I might have been involved in, they might have failed, but you only need to be right once in business. I'm glad that I invested my time, my money, my energy, my resources, my focus, my discipline, my everything into business. Because years later now, I'm starting to become gray. I'm looking in the mirror. I don't have any regrets. I can only smile when I see these kids on social media drinking more fire in different townships, in different villages all over the country. When I see people posting about it on social media, when I'm like, wow, this was our dream. This is what we wanted to achieve back then. I'm glad I let go of all those instant bags and I focused on a long-term vision, because we are now slowly starting to see the fruits. And that's what I'd like to encourage you to do as well, Mtansekai. Wanakokai, start having that investor mindset. Start having to go in. I'm actually going to put a link in the description of the #1 rule in investing. The most simplest book. You can even listen to the audio book. I'll put the link in the description. It'll change your life. It'll change how you think. And go read other books as well. Other videos that I've done, I've recommended books, and I'll continue to recommend other books, and I'll continue to do videos like these where I'm summarizing certain books that I think are helping me, that I think can help you also. So start replacing, or start adopting a mindset of replacing saving with investing. Replace the word save with invest. Replace the word savings with the word investments. Danko.